Hey, it's Dr. Asatar Bear, and in this lecture, we're going to be talking about the history of money. This is part two, uh, covering the fractional reserve banking system and the development of paper money. All right, so we began in the first lecture by talking about the first of our three eras of money. Uh, so we're gonna pick up with the second era. Right, the first era is the commodity money era. Commodity money. Right, so like I said, this is many thousands of years old. Uh, thousands of years old. Predates history, in fact, written history. Um, and one of the things that we notice about this period is that there's long periods of price stability. All right, price stability. What that means is a stable price level, and where inflation, as we know it in the modern era, is absent. Okay, so inflation during this period is episodic. There are periods, right? The most famous one I mentioned, associated with the discovery of the New World and the bringing of gold to Europe and so forth. Um, but that's very different from the modern experience, right? The modern experience is that inflation is a reality almost every single month of every single year, right? So episodic rather than chronic, as it currently is, that's very different. Okay, um, and one of the things that we just have to review and make sure we understand much earlier in the course when we were talking about inflation, we talk about this old theory of inflation known as the quantity theory of money. Right, quantity theory of money, very famous in the history of economic thought. Uh, this is a very simple equation. Okay, it's m times v equals p times q. All right, and again, m represents an important concept which we're going to be using in this section. Okay, that's the concept of the money supply. All right, that what that means is the total amount of money that is in circulation, the economy that exists in the economy. Okay, v is the velocity of money. Okay, velocity of money. What that means is the number of transactions per time period. Okay, per day or per week or whatever it is. Right, P refers to the price level, and Q refers to the total quantity of goods and services. So you may recall a much earlier discussion of this. What we found is if we consider in the short run the total quantity of goods, that's the nominal GDP, to be fixed in the short run, right? And the velocity of money to also be fixed in the short run. Then we get this. This is what makes it a theory of inflation, right? To say, well, if there is an increase in the price level, that is because there's been an increase in the money supply. All right. So the point I want to make, the point I want to just show from this section is that under the commodity money era, the reason that we had a stable price level is that the money supply is relatively stable. Okay, um, the money supply grows relatively slowly. Right, there are not rapid, dramatic shifts in the money supply as a matter of course. That happens occasionally. Right, again, inflation is episodic. There are some episodes of inflation, but that doesn't happen on year to year. During normal times, the money supply grows relatively slowly. As long as the money supply grows at the same general rate of growth as the economy, then you have this long periods of price stability that occur over time. Now that all changes as we get into our second great monetary era. Okay, and that is the era of paper money that is convertible on demand. All right, paper money that is convertible on demand. This is much newer, right? This has a more of an established history, okay? this begins about 500 years ago, okay? About 500 years old. So this begins at a time when capitalism itself is just in its very early stages, or even in its kind of pre-formation stages, right? 500 years ago, when we look at Europe, Europe is still dominated by the old system, okay? That is the system of feudalism in Europe, lords and serfs and kings and barons and knights and all that stuff, right? That's the system of feudalism, which had a lot of restrictions on markets, which did not have wage labor being very prevalent and so forth. Okay, so the roots of this new form of money come out of that time period, but a time when trade and markets are going through a rapid development, particularly in the port centers of Europe, places like, for example, Holland. Um, all right, the Dutch are great traders and merchants and so forth, and uh, Holland and Amsterdam become great centers of trade. Okay, so the paper money comes out of this. Okay, it comes out of because of the growth of trade and all of the associated need for security, for convenience. Uh, we had trade developing over much longer distances, involving ships. The development of the modern system of international trade begins at around this time. The discovery of the New World, the beginning of the transatlantic slave trade, all of these things. Okay, so this gives rise to new innovations, new developments. Okay, and among them, we had an institution, the medieval goldsmiths. All right, goldsmiths. What are they doing? They make jewelry. All right, like we talked about when we talked about the roots of gold. Gold is the king of commodity money, right? And gold has different uses, right? One of its main uses is the making of jewelry. Okay, so goldsmiths are working with this very precious material, and they have something which is necessary in order to have this business, right? They have a secure form of storing it. Okay, they have secure storage. So because but plenty of people want to rob them, right? So they have guards and vaults and all of this, right? And goldsmiths about 500 years ago begin to develop a new and different line of business. Rather than making jewelry, they begin to rent space in their vault, all right, in exchange for a payment. Okay, so they would take in deposits of all kinds of valuable items, the gold and silver, and I'm imagining something that looks like a dragon's hoard, that kind of thing, right? And what they would do is they would issue a receipt, okay? Because of course the people who deposit this, who are renting the space, of course they want their stuff back, right? So okay, whatever fancy golden um, goblet or whatever the hell it is, right? Covered with jewels. And okay, you've put that in my care, and I'm going to give you a receipt that says when you show up, you can redeem that in exchange for your property. And of course, that costs something, right? That's what makes it a viable business, right? We will charge you money in order to store your valuables, which of course you can pick up at any time, right? The what this be? It's kind of like a safety deposit box, right? The same kind of concept, right? But what begins to happen very quickly, okay, is that all of this becomes standardized. All right, all of this becomes standardized. So you have, gold and silver and sculptures and goblets and weapons and all kinds of fancy stuff, right? But over time, what develops is the mainstay of this becomes coins, right? Coins are standardized form of gold and silver. They're at a standard fineness. They're at a standard weight, all of this, okay? And these goldsmiths also begin to standardize their receipts, okay? Because what also happens about 500 years ago is the development of the printing press, right? So the first, printed materials, the Gutenberg Bible and so forth, right, occur at around this time, okay? So the printing press is used to create standardized receipts, right? And the deal starts to slowly change. It starts to be like, okay, at first you're taking in deposits. The person is going to want to pick up exactly what they deposited, right? But over time, it starts to become a little looser, right? That is, look, when everything becomes standardized, when there's standardized coins that are gold and silver, the goldsmith stops guaranteeing that you will get the exact same coins that you deposited. They said, look, we'll give you, if you put in 500 gold coins, then, you can get 500 gold coins. We're not going to guarantee that those are your exact coins, but how does it matter, right? Gold is gold, right? Silver is silver, okay? So this is important because what begins to happen here is that the concept of that something would be convertible upon demand, right? That you would take this receipt or this note, okay, same thing, and that you could take it in at any point to this institution as goldsmith and then convert it to the gold or the silver anytime you wanted, right? So what happens here that is revolutionary in terms of the history of money and finance is that the notes begin to be widely accepted as a form of payment. Right? They begin to be widely accepted because there is a trust that is created here, right? So the note might say something like this, right? It might say, okay, we have, Goldsmiths and Sons Bank, because this is what these institutions become known as, right? And here's the note, right? It says, okay, you come to Goldsmiths and Sons Bank, and this note you may redeem for 1 ounce of gold, right? So, all right, this is a 1 ounce gold note. And what can you do anytime you like? Well, you can convert it for the actual physical, I'll draw a little picture of it, gold coin, right? 1 ounce of gold, right? At that set standard of purity and set weight and all this stuff, right? So this is what we mean by paper money that is convertible on demand, okay? So initially, it's just a kind of convenience, right? Like, is someone making you take this note or whatever? Not at all. No, that's not how it develops, right? It develops is purely voluntary. But people understand there's some conveniences here. Fantastic, right? Like, can you carry 100 pieces of gold on yourself? Sure, but that's hard. Gold is heavy. If you put it in a sack and throw it over your shoulder, it's going to be jingling. That's going to be attracting robbers. But could you take 100 of these notes and secure it on yourself? Oh yeah, a lot lighter, a lot more secure. Nobody even knows you have it on you, right? People are always trying to cut your purse strings and steal your gold, but they don't even know about these notes, right? So much more convenient, especially if we're talking about trade over great distances. All right, so when the notes become widely accepted as a form of payment, that's when something becomes money, right? That's one of our 3 economic functions of money. Okay, so these first banks have this issue, right? What they essentially are doing is they have a set of wealth. Okay, let's imagine it's like this. Okay, they have 10,000 ounces of gold, and this is what has been deposited in their trust, right? Like the deal is I give you my gold and I can trade in this piece of paper at any time, right? The paper itself does not have value, right? The paper is low value. That's not worth an ounce of gold in the slightest, right? What makes it have value is that I can trade it in, right? The trust that people have in this institution, okay? Knowing that, hey, they have 10,000 ounces of gold, all right? That's in the vault. Now, they have issued 10,000 of these 1 ounce gold notes, right? These are the receipts, okay? So I just want to point out what this refers to is, right, the banks, the 10,000 ounces of gold represents real assets, right? Like, why does that have value? Well, it has value for the reasons that we discussed in the last lecture, right? That is, there's a cost of production, there's labor embodied in finding and mining and refining the gold, right? And it also has value because there's demand, right? Gold has useful properties. We like it. We want it, right? So these real assets are here, right? Now the notes, these are not real assets. What these are, these represent titles of ownership, okay? A title of ownership. Like, for example, there's a difference between your car, right? The thing that you actually drive, and the title to your car, right? The title to your car, you can't drive that. That's just a piece of paper, right? All that does is says who owns it. But of course, that's important, right? So we need that, but it's different, right? It's not the thing itself. It just shows us who owns it, okay? In the same way that paper money represents titles of ownership to the actual assets, right? That the fact that it says 1 ounce of gold on a piece of paper doesn't really mean anything by itself, right? So we could say this is the actual value over here, the gold. Over here, what we have is the signifier of value, right? The sign, that points to value. Value over here, right? Now, initially, banks are they issue only as many notes as they actually have in gold. Okay, that is how banking developed. We now call this, it's not really called anything at the time, but we now call this a full reserve system, okay, or a full reserve bank. What that refers to is that every single note is fully backed, right? It is fully convertible, and it would be possible to convert every single note into gold at the same time, right? This is a stable kind of banking. It can never collapse. Um, it's this is how it began. Okay, but slowly, what began to happen, we don't know exactly what the first bank that did this was. What banks find out is that there is a relatively slow demand on any given day. Okay, on any given day, few people show up to redeem their notes, right? So redeem the note, that means they trade their note in for the gold, which they can do at any time, right? That's what we mean by convertible on demand. But relatively few people actually do that because the paper fulfills all of the functions of money, right? It's a means of payment. It is a unit of account, okay? Because it's the same unit, right? The 1 ounce of gold versus the piece of paper, same unit there, right? The paper is also a store of value, okay? So if you have, 1,000 of these pieces of paper, right, as long as they're notes from this bank, well, you can trade those in anytime you want. They represent a store of value, right? So few people show up to redeem the notes on any given day, right? Perhaps the number that redeem the notes is like 1,000, right? So that represents like the turnover that's going on here, right? On any given day, 1,000 people show up with their notes and say, I want gold. But at the same time, people are also depositing money all the time, right? They're saying, okay, here's the gold. I want to do this new thing, this paper money, right? So initially, even though it starts off being full reserve, what someone figures out at some point is, what if we just boosted the number of notes a little bit, right? What if instead of having 10,000 notes, we issued, let's say, 11,000, right? Now, is this gonna create a problem? Well, it might, right? It might, because now we have the issue, which is that not all of these titles of ownership can actually be redeemed at the same time, right? This is something new. This is the fractional reserve banking system, right? Fractional reserve banking is born at that moment. Again, we don't know exactly what bank first did this, but why would you do this, right? Why would you do this? Well, because look at what's happened here, right? Rather than just taking the revenue from, people have to pay for this, right? They have to, you turn in your gold and you get your note. You know, you someone has to actually pay for this, okay? So as this becomes standardized, all this stuff happens around the same time, right? But the bank realizes is they can simply create more notes, right? Now, why would they create 1,000 extra gold notes? Well, that's like creating 1,000 ounces of gold, all right? Why would you create 1,000 ounces of gold? Look, at current gold prices, it's worth about $1.5 million, right? So why would you create $1.5 million? Like, duh, right? You do it because you want to be rich, Uh, you do it because you can. And what the thinking of the bank is, no one is going to notice this, right? Because on any given day, only 1,000 people or so show up and redeem their notes. We can totally cover that, right? As long as it's less than 10,000 that show up, the system is fine, right? But so, whenever something, nobody notices, right? Well, then you might do that again. You might do that more, right? You might go, instead of keeping that at 11,000, well, maybe you go to 20,000. The odds of that getting discovered are still pretty low. Where this settles historically is at about 4 to 1. All right, so isn't that amazing, right? We end up with a situation where we have 40,000 notes and 10,000 actual ounces of gold, right? So we have multiple titles of ownership, more than one title of ownership per coin. That is what fractional reserve banking is, okay? And the system develops, like I said, about 500 years ago, and it spreads, right? It becomes a highly profitable system, okay? Highly profitable system. And it creates something new that has never before existed in the money system, right? This new era of money. Um, and that is something called a money multiplier, okay? So the first thing is we need to define what's called the reserve ratio. All right, so we can think of the reserve ratio as the proportion of the notes that are actually backed, right? That are actually convertible, right? If we had to do it all at once, right? The bank is taking advantage of the fact that, look, like I said, on any given day, very few people show up and want to convert. But what if they all did? What proportion are actually convertible? Okay, so the way we would do that is we would say, all right, well, what's the number of ounces of actual gold, and then divide that by the number of claims on that gold, the actual number of notes, right? So in our example, right, where this starts with 10,000 over 10,000, that's the full reserve system. But where we end up, right, when we're at 40,000, would look like this, right? We got 10,000 ounces of gold. We've got 40,000 notes or claims on that gold. And so the reserve ratio then settles at 0.25, okay? And that's kind of historically accurate, right? And historically accurate. So what is unique about this? What's special about this from an economic perspective is that we have for the first time money creation and destruction occurring through the banking system. Okay, so let's just define this. Okay, so what is money creation? Well, we can see that what's happened here, right, is that 10,000 ounces of actual gold have somehow magically turned into 40,000 notes, right? So 10,000 becomes 40,000, right? Yeah, how has this happened? Now, I kid you not, the phrase that is used to describe this in economic theory is that it was created out of thin air. Guys, I am not making that up. That is the exact phrase that's used throughout the literature. Created out of thin air. My God, what is this, magic? I thought this was economics class. This is magic. It sounds like a wizard that's reached into their magical cap and start pulling out gold coins infinitely or something like that, right? Ooh, I wish I had a cap like that. That'd be fantastic. Well, this is as close as we can get outside of a, fantasy novel or whatever, right? That's as close as we can get to the money creation. Okay, so the way that this works is we create a concept known as the money multiplier. All right, so money multiplier. Now we're going to call the reserve ratio RR. Okay, little r, reserve ratio. And we're going to define the money multiplier as the inverse of that. Okay, so 1 over the reserve ratio. All right, so 1 over 0.25 gives us 4. And I think this meshes with what we just saw, right? What we saw is 10,000 ounces of actual gold become 40,000 in spending power, right? Because each one of those notes can be spent in the same exact way that a gold coin can be spent, right? So in terms of spending power, that's what's happened. Spending power, money, has appeared out of thin air, right? Amazing, okay? That's money creation, right? Now, it happens as the deposits to banks grow, right? And it happens because there's a fractional reserve banking system, right? Because there are notes that are unbacked that they, you know. All right, so now of course this entire thing can happen in the opposite direction just as easily, right? So money creation is one side of it. The other side of it is called money destruction. Okay, and just as money creation occurs out of thin air, money is created out of thin air. Money destruction means it's destroyed out of thin air. Unbelievable, right? Amazing. Okay, so money destruction occurs. This would just be the negative, right? So if you withdrew this money, then it would the notes would like evaporate, right? Now, how does that happen? The notes don't actually evaporate. But to understand money destruction, let's imagine that this happens, right? Let's imagine that that day happens where more people want to redeem the notes than there are actual gold, right? So let's say this happens, okay? More people show up to redeem their notes than there is gold available, okay? And on this day, we have a problem, right? The bank says no. The bank says no, we actually can't do it. Could you wait? Could we give us some more time? We just need a little more time, right? The bank says no, and this causes a problem, right? Now everyone wants their gold, right? They don't want to be stuck with the paper. They know the paper has no actual value. The point of this whole thing is that they've trusted the bank. They didn't quite realize that the bank was actually not very trustworthy, right? Like, because the problem with this is it doesn't not really about trust, right? It's about you can't create more titles of ownership than there is actual stuff, right? If you do that, you've committed fraud, right? I mean that's what that is, right? You can't promise the same good to more than one person, right? That's essentially what this is, right? Even if they don't find out for a long time, eventually the truth is going to be revealed. Eventually it's going to be revealed. and then everybody is going to want to make sure that they are covered, right? But not everyone is covered. That's the problem, right? And what happens? Well, the notes become worthless. Because if you can't trade them in for the gold, they're not worth an ounce of gold anymore. And money is destroyed, right? This is called a bank panic, right? Or a bank run, right? Conveys that sense of panic. We're like running to the bank. I want my gold, right? The bank collapses, right? The bank collapses. And does this happen? Absolutely. Yes, it does happen, right? The last 500 years that this system has been around is 500 years of this happening, right? Doesn't happen all the time, right? We have periods of stability, but there's many, many periods of bank collapse, of bank failure, okay? And during that period, the money is destroyed. So this bank that now goes out of business, well, that 10,000 ounces is gone, but so is that 40,000 notes, right? So that is what money destruction is, okay? So remember, under the old commodity money era, the money supply is very stable. But now we have something very different. That is, the money supply can actually grow right here, right, through money creation and contract through money destruction. That is very new, right? And that happens along with the development of capitalism itself, okay? And that has important consequences for the economy as we're going to explore. All right, so let's look at banks' profits and their incentive structure. Okay, banks' profits and their incentives. So what happens here, of course, what happens very quickly is that banks, they create these notes, right? And what they end up doing with the notes is lending them. Okay, so banks do a whole set of different kinds of financial innovation, right? Financial innovation. So, like I said, the initial moment of this is the creation of these notes. Okay, so they create these notes and then they lend the notes. Okay, so banks become sources of lending that is much greater than anything that existed in the past. Right, the modern credit economy with lots of borrowing and lending that has its roots in this system of banking. Okay, so they make loans and they also do something new. They introduce other kinds of innovation. So one of these innovations is checking. Okay, so now checking accounts are actually kind of old, right? They've been around for hundreds of years, but you have to think about it relative to the time period, right? The check is actually a tremendous financial innovation. Okay, what this allows you to do is you don't actually even need the pieces of paper, right? A check is essentially you write your own piece of paper, right? And then the money gets transferred inside the banking system, right? So, uh, when you write a check, you essentially create paper money, which is very short-term use, right? It's used for that transaction, then it gets deposited, right? So what you've done here is very interesting, right? You what is actually money? Uh, the notion of what money is becomes even more diffuse, right? So under the old gold commodity system, money is that's a very simple answer, right? Money is this. It looks like this, right? This is a gold coin. That's money, right? Very, very simple. Under the new system with the paper, okay, well, what's money? Well, it's either this or it's this thing, right? With the, goldsmiths are us, right? This note that you can redeem it, right? So it's either the actual coin or it's the note. But in the era of checking, if you write someone a check, what is that, right? Is the check money? I mean, yes, it is money, right? Because it serves the functions of money, right? It's the means of payment, etc. Right? So, but it's a very strange kind of money, right? Like whatever you write on it that's how much money it is, right? That's very different. Like, if something costs you 10 coins, you need actually 10 coins, right? You can't just, how about I write something on this coin? No, right? You can't do that. If it costs you 10 coins, okay, I can pay in notes, but you need to pay with 10 of them, right? Well, you can write any number you want on here, right? So what begins to occur here is that money begins to represent data, right? Like what makes the check good is that it's an accounting entry, right? So where is the money? What is the money, right? The money represents that there are numbers associated with your account, right? That's very, very abstract, right? We are on the road to money being numbers, right? Money being essentially information, being data, right? That is a very new thing, okay? So financial innovation occurs, and banks realize something very quickly. What they realize is the lower their reserves are, okay? That is, the lower their reserve ratio, the higher their profits are, right? The lower their reserves, the higher their profits, okay? But this also creates a higher risk of default, right? Of the bank collapsing, right? Which is bad, right? That's bad. But in good times, banks are seduced by the lure of higher profits. Okay, so let's visualize what's going on from the perspective of the bank. Okay, so on any given day, they have this happening. Okay, deposits are entering the bank. Okay, let's say that this represents the deposits per day. Okay, a stream of income entering the bank. Okay, um, so and then of course on any given day they also have withdrawals. Okay, so again per day. Okay, so visualize this as a stream that is leaving the bank. Okay, so and what is it in the center, right? The deposits are coming in to what, right? The withdrawals are leaving. Okay, so this center area is the bank's reserves. Okay, so now before we looked at what are the total, amount deposited and whatever all this stuff, the total number of notes. Now we're looking at it in a more fluid fashion, right? As a matter of the flows, or the inflow and the outflow. Okay, so deposits represent the inflow, withdrawals the outflow. All right. So see it as a stream, right? Like water is flowing in, water is flowing out. Okay. So keep in mind that the more banks lend, that is where their profits begin to come from, right? Initially, under the full reserve system, they charge fees and whatever. That very quickly goes away. As fractional reserve banking develops, banks don't charge fees in order to deposit. They try to make it as easy and as welcoming to deposits or free, right? But their profits come from the loans that they make, okay? So the reserves represent a lost opportunity to profit, right? So let's imagine this, right? Let's imagine a bank that has 100,000 in reserves, okay, and has an inflow of 5,000 and an outflow of also about 5,000, right? So money's coming in, money's exiting, and it's at about the roughly equal, okay? So, but meanwhile, they have 100,000 in reserves, right? So how does the bank see this, right? This is kind of like, again, imagine a stream is flowing in, there's a lake right here, a pretty big one, and a stream is flowing out, right? So you can see the thinking of the bank is kind of like, well, gosh, if we loaned some of these reserves, well, they wouldn't be reserves anymore. They wouldn't be, in our vault, right? In our vault. They wouldn't be there. But on the other side, we would be getting the interest that is the key to our profits, right? This is where bank profits come from, right? Making loans, all right? So the less we have in our vault, the greater the interest is and the greater our profits, right? It's like, okay, could you imagine this? Imagine that this stream of deposits that flows in has just a smaller lake, and then it flows out, right? Smaller lake, like not 100,000, but let's say 50,000. Okay. Okay. All right. Well, wouldn't it be more profitable though if we had only 10,000? You see where this is going, right? The most highly profitable situation is where you actually have zero here, right? And this could work. This is a zero reserve system, okay? Zero reserve system. Now it's pretty risky because you're trusting that on any given day the deposits and the withdrawals are roughly equal, right? Like if you have zero reserve and let's say you have for some reason you have 6,000 in withdrawals, you wouldn't be able to cover that, right? You're trusting that each deposit then goes out in a withdrawal, right? So zero reserve, highly risky, right? But very profitable, okay? Very profitable. In fact, we will have maximized the profit on a zero reserve system for banks, okay? All right, so this brings us, so this is the bank's incentive structure, right? We have created, just through this institution, right, it's created a kind of a conflict, okay? That is, the bank's individual pursuit of profit leads it to take a very high degree of risk, right? That's a kind of a conflict. And this is why historically we settle at about a ratio of about 0.25, right? Because bank failures occur. Banks don't want that. They want to avoid that. But they also are driven to achieve greater profits, to take greater risks, right? And the smaller banks tend to take greater risks so that they can grow, right? So that they can compete with their larger competitors, okay? A conflict between the risk that is being taken on, a risk, by the way, which the bank doesn't entirely bear, right? Now, the bank doesn't want to collapse, right? But they're ultimately, it's not good for them. But they're not the only ones who are badly affected, right? A bank collapse doesn't just affect that bank, it affects all of the people who lost their deposits, right? So that conflict is between banks and society as a whole, right? All of the depositors are actually taking a risk. They don't even realize it, right? If they knew that they were taking a risk, no doubt they would demand more of a return, right? The system runs on trust, which banks are breaking, right? It's not at all clear to the public that this is occurring, right? The promise that banks make is you can convert at any time, right? People don't really understand the risk that they're taking, and that's kind of the key to banks' profitability here. All right, so now we come to the critique of this system, because over people study this, of course, over time, and people said, look, there's a couple of problems with this, right? There's three basic problems with this fractional reserve banking system. Three problems. Fractional reserve banking. The first of these problems, I'll start with the one that is most often ignored, which is the immorality of this, right? It is a system which is essentially based on fraud, right? We do not permit this kind of fraud in any other business. It would be considered illegal, right? You cannot sell more than one product, right? You can't sell in more than one title to that product, I should say, right? That is, you can't sell 4 titles to the same car, obviously, right? That's obviously a fraud, even if, hey, people don't drive their car every single minute of every single day, right? Couldn't you create a profitable business where you sold the car twice? Oh, you drive it at night, you drive it during the day. Well, look, that is not how we understand private property to exist, right? If you signed on to that and you knew that was the deal, fine, right? But that is not the deal that banks offer, right? Banks don't say, well, hey, if you deposit this, there is a risk that you won't get your deposit back. but it's going to be very profitable for us. That's the upside. But why? That's not an upside. What the hell's that, right? That's so the immorality of this, right? It is immoral and it's illegal, right? To commit this kind of fraud. Why is it not illegal for banks? Well, here's the thing, right? Modern law uh, is also about 500 years old, right? Modern law was written uh, with a loophole in it for banks, right? So that this is not illegal what banks do, right? Even if it would be for any other business, but it's not actually illegal for banks. All right, point two is that the system is highly fragile, right? It is prone to collapse at any time, right? It's prone to collapse. Um, it is the most fragile way to possibly have a a financial system, right? It in that sense makes no sense at all, right? Like, why on earth? It's like if you came to a swamp and said, "This place, looks great. Let's build a city here." You say, "Wow, that might not be the best foundation. Some of these buildings might sink." Nope, I don't care. I'm going to build it here. Well, you're taking a big risk there, right? You're making something. You're building on an insecure foundation, right? The problem with the fractional reserve system is that it is actually permanently insolvent. I mean, that's what this is called, right? It's called insolvency when your liabilities permanently exceed your assets. That is insolvency, right? So we could say banks are actually bankrupt all the time, right? They're 24/7 bankrupt. Wow. All that they're waiting for is for that insolvency to be recognized, to be revealed by the market, right? To be revealed by the market. So unbelievable, right? A fragile thing. And this fragility also creates a risk to society, okay? Now that risk is spread out in weird ways, right? There's because when the bank collapses, it's going to harm the depositors, of course, right? It's going to harm the depositors, but it's not going to be just limited to them, right? There may be damage to the economy that's much more widespread than even just those who lose their money, right? Because everything is connected to everything else, right? We learned about this when we talked about the Keynesian money multiplier or spending multiplier, rather, right? So if there's less spending in the economy, that's going to reverberate. That's going to affect more than just those individuals directly affected. There's going to be secondary, tertiary effects, right? Indirect effects. Okay, so that brings us to our third point. Okay, which is that the fractional reserve banking system, okay, which involves this money creation and money destruction, what this does is it causes the money supply to expand and contract. Expand and contract. Wow. And what does that do, right? Well, what this does is it creates a pro-cyclical effect in the economy, all right? So now remember, Keynesian economics, okay, we talk about this a lot, right? The goal of Keynesian economics is to take out the pro-cyclical effects from the economy, right? We want all of our uh, policies and whatever to be counter-cyclical, okay? So the money creation and destruction moment is highly, highly pro-cyclical. In fact, it may be the most pro-cyclical thing of all in the economy, right? It might even be the basis of the modern business cycle. I mean, we don't know because we don't have another form of capitalism to refer to, right? That is, the fractional reserve banking system is ubiquitous, right? It's that every bank pretty much uses this, right? It's worldwide, and has been for the last 500 years or so. So we can't really say, right? We don't have capitalism without this to compare it to, right? But the capitalism that we do know, we know it has a problem, right? It's got a business cycle, and we also know that this system enhances that business cycle. It makes it worse, right? So how does that occur? Well, okay, let's say we're in the upcycle part of it, right? During the upcycle, okay, when we have GDP growth, when that's occurring, right, GDP growth tends to lead to a growth in bank deposits. All right, so bank deposits increase as the economy grows. And as bank deposits increase, we have money creation. All right. And the way the primary mechanism that this occurs through is, okay, so as loans increase, we have money creation, right? And money creation, and especially loans, enables spending to occur that otherwise would not occur, all right? So the aggregate demand or total spending increases, right? And as the aggregate demand increases, well, it causes effects which depend on where we are relative to full output, full employment, right? So the possible effects that this could have is increase GDP further, and it could increase the price level. How much of each one of these we're going to get, again, that depends on where we are, right? But you see the issue, right? This is what pro-cyclical means. Growth leads to more growth, right? But what if that is not fully sustainable, right? What if some of this growth is short-term growth that will be exhausted, right? What if there isn't a fundamental basis for that growth to continue? Well, we might start moving into a contraction. We might start moving into a recession, a period where GDP is falling, where employment is falling, right? And when we get into that, this is always associated with a decrease in bank deposits, all right? Withdrawals is what pick up. Withdrawals pick up here, right? What happens when people lose their job? Well, they are going to withdraw more, right? And so now what begins to happen is money destruction, right? The volume of loans diminishes, okay? Now, many of the loans that banks made, they can't just get them back, right? They are going to be repaid over time, but what they can do is not make new loans, okay? So what we often see is that new loans basically go to zero, all right? They can't do much about the loans that they've already made. They can't retract them. The money's already been spent, right? But they can stop making new loans. And this often causes a very severe contraction, right? So that is, many, many businesses and individuals were relying on those loans. Once they are now withdrawn, you can't get them. This has a very negative effect on aggregate demand, right? Total spending falls. And we get our twin effects, right? GDP falls, and perhaps the price level falls again, depending on how close we are to full employment. Okay, so the three big problems with the fractional reserve system, right? The immorality of it, the fragility of it, and the pro-cyclicality of it. Okay, so these are pretty severe problems, right? I mean, maybe it would make sense to redesign this system, right? Like, I got an idea. Let's not build our city on a swamp. Let's build it on solid ground. Let's not have it be possible for it to collapse. I mean, a full reserve system would not have this, right? You would have to pay to do banking, yes, but that would be more honest, right? You wouldn't be paying in this coin that you didn't understand, right? Which is the risk of insolvency and what might happen to the entire economy as a result. Okay, so the history of banking is, in a lot of ways, develops in response, especially to the fragile nature. Okay, the history of banking is the different attempts to try to mitigate the risk of collapse, right? To deal with the problem that the system is always very fragile. Okay, and there's a bunch of different ways that banks try to do this, try to mitigate that risk. Okay, so the first is, when banks face a contraction, when they face a moment when there's greater demand for their deposits than what they actually have, right? So what happens here is that banks' reserves become exhausted or they get low, right? Because banks can sometimes they can see it coming. Oh, well, there's more people withdrawing. Oh my God, at this rate, our reserves are going to be exhausted, right? So when bank reserves get exhausted or they're even close to being exhausted, they know they have a problem, right? They need a loan because they see it as a temporary problem, right? Like I've presented it as this is just like the law of gravity, like hey, you throw something up and it will eventually fall, I mean, like, let's be honest, right? The banks don't quite see it that way, right? They see it like, hey, this was worked yesterday, it worked the day before that. Why can't it work forever? Um, why does our insolvency ever have to be revealed, right? If we could just get a loan at the time when our reserves are low, then maybe the moment would pass. Maybe people would go back to accepting the paper and they don't need to convert and get the. We just need a loan. We need, they use this word, liquidity. We just need a little more liquidity. Um, I've often thought that liquidity is the most dishonest word in the entire lexicon of economics. Um, but this is how they see it, right? Banks see it as we have a liquidity problem. We don't quite have the money to cover it right now. Um, that's dishonest, right? Because the problem is not illiquidity. The problem is insolvency. That's not the same, right? That's so they're putting a nice, they're saying in a nice way. We just need a little liquidity. No, the problem is you are insolvent. That's the problem, right? But nonetheless, right, when banks or reserves are exhausted and need a loan, but who are they going to go for a loan, right? Where did they get a loan? Where to get a loan? I mean, the normal place you would go to get a loan would be a bank. But you can't go to another bank to get a loan. I mean, what's that bank going to say? Nah, you know what? I see what's going on here. You're about to collapse, and once you do that, I'll just buy your building and I'll expand my bank, right? You can't really go to another bank. You can't go to another bank. They're your competitors after all. Right? Banks compete with one another. Say, look, as long as we're competing, even though this would be a benefit, right, to us all, we can't do that. We need a bank that doesn't compete with us directly, that doesn't offer loans to the public, that doesn't try to get deposits or anything like this. We need a bank that is only for other banks, that loans to other banks when they have a problem. Okay, and this is develops into something which is now called a central bank. Okay, that is a bank for other banks. Okay, to make loans when it's needed, right? In order to avoid the problem of the bank collapsing. Okay. Now, the first one of these central banks that we know of, a bank that loans to other banks, uh, was in Sweden. Okay, this is called the Riksbank, Swedish Riksbank, um, and this was created in 1668. Okay, so wow, that's old, right? That's a 350-year-old institution. Um, that is what we know of as the first central bank. Okay, they start off as what we now in modern language call the lender of last resort. Right, the lender of last resort. That's what the central bank is. Um, Over time, these develop, right, and they become a more and more central institution in banking. But initially, they start off as a voluntary, like a kind of a club that banks can join and they have to pay dues to fund it and whatever. But you can see some banker making the argument, well, this is going to benefit us all, right? Yeah, we have to pay for it, but okay, that when any one of us could get into trouble at any time, and when we do, we're going to want this. So come on, everybody, chip in, right? So that is how central banks develop, right? Over time, they become less and less voluntary, right? Over time, it becomes non-optional, that central banks consolidate their position, they become associated with the government and so forth. Laws and regulations are passed which end the time of what's called free banking, right? Um, so, and a centralization occurs over time. Okay, so the central banks become national institutions. Okay, they don't start off that way, right? They start off as being like a trade association. Okay, that's how they start off, but they get nationalized pretty quickly. Okay, during this period, right? The late 1600s, early 1700s, we have the creation of a central bank in England and in France, right? So countries that are ahead in terms of the development of capitalism, as a rule, also develop central banking sooner, right? Because they're developing lots of financial institutions at once. Okay, and as the central banks grow and develop, they develop a set of rules. Okay, so a set of rules, and there's a whole bunch of these, right? But the most important rule is they mandate that there has to be a minimum reserve ratio that they demand. Okay, so a minimum RR, in other words, because the central banks, right? They're composed of bankers themselves, right? They understand. Look, we know the deal. The deal is this: you have a built-in incentive to want to lower your reserve ratio as much as possible. Uh, if you have a central bank that is lending to you as a last resort, well, we know what that's going to do, right? So if you are protected from risk, you're going to do what? You're going to take more risk. Of course you are. This is called moral hazard in economic theory, right? Say, hey, you've got a really fast car, but don't drive fast. Don't break the speed limit. That's bad. That's dangerous. Don't do that. And you're going to go, well, just in case, right? Don't go fast, but just in case, I'm going to make your car super, super safe. Titanium frame and all the safety equipment, airbags here, there, everywhere, right? But don't drive fast. Okay, don't do it. And you're going to be like, all right, yeah, I'll take that under advisement. Right? So, you might take on more risk if someone protects you from, especially from the downside possibility, right? And this is what central banks do. So they're like, okay, we need to have rules. We need to say, look, you can't take on. There's a limit to how much risk you can take on. Your reserve ratio can only go so low. Okay. And in the United States, this minimum reserve ratio is set at 0.1. All right. So imagine this, right? So 0.1. What does this mean? Okay, let's do the math, right? So if the reserve ratio is 0.1, well, this means that an institution that has 10,000 ounces of gold is only able to issue 100,000 notes, right? Be responsible. I mean, wow, that sounds like, okay, yeah, that's pretty, I can follow that. It'd be like, imagine somebody says, obey the speed limit, okay, it's 250 miles an hour. I'm like, oh, all right, yeah, I'll probably be able to stay below that. That's 250 miles an hour is fast. That's very fast, right? I mean, yeah, you stay below that, okay? So you have to obey this minimum reserve ratio, okay? Now, it turns out that banks actually develop loopholes to this. They develop loopholes. They have ways of getting around this, right? This is one of the oldest rules of central banking. Is there's going to be a minimum reserve ratio, but banks have found a ways, right? They've paid close attention to the system of rules, and they know how to break it, right? They don't always do that, but in the next section, we're going to talk about how that occurs. All right. Okay. So, like I said, the history of banking is an attempt to mitigate the risk of collapse. One big way of doing that is through central banking. A secondary way of doing this is for banks to develop a close relationship with the government. All right, banks develop a very close relationship with government. Okay, so one way that they do this is, through loans and through facilitating government borrowing, right? Governments borrow, to pay off war debts and things like this, right? They accumulate the debts, they issue bonds. Banks become involved with all these different financial transactions. Okay, so with the bond market, with loans to government and so forth, right? So as they develop this much closer relationship with government, closer than a lot of other businesses have, right? Like other businesses don't necessarily have basically what is their trade association becomes part of the government, right? Like central banks become part of the government over time, right? They become national, they become like a government agency. Like the dairy farmers or the wheat farmers or whatever, they don't have a government agency for them, right? But the banks do, right? Banks are very close to government. Their interests are represented in government much more so than any other business, right? As they develop this close relationship with government, they use this to say, okay, when we are facing a risk of collapse, and let's say that becomes systemic, that the many banks are facing that, they say, look, okay, so when the reserves get low, banks often will petition the government, okay? And here's the thing that they want from government, okay? They want to suspend the convertibility, right? Remember, this whole thing is based on, okay, you can convert the notes into gold anytime you want. What happens is, the system, like I said, permanently insolvent. There are moments where the entire thing collapses, okay? Even though central banks develop to try to mitigate this risk, what they do is they make loans, right? But they don't have enough money to loan to every single bank at the same time. What central banks can do is basically move around reserves to cover banks that are in need, okay? They can cover banks that are in need, but they can't cover everyone. There's just not enough money, right? There's far too many unbacked notes out there, okay? So the only thing that banks can do in that situation, that is, when many banks are facing problems, many banks have low reserves, they say, look, just as a temporary measure, please let us do this. Suspend the convertibility, okay? Allow us to say to people, listen, it's a national emergency. We are not going to give any gold, right? And banks provide perhaps history's most audacious explanation for this. They say there's a gold shortage. A gold shortage. I wish we could help, but there was a terrible shortage of gold. I love that. That's hilarious, right? A gold shortage. So let me get this straight. You created 100,000 notes on 10,000 ounces. There's still 10,000 ounces, am I right? Maybe this is the problem then, right? Maybe it's not a gold shortage. I mean, come on, right? That's an unbelievably audacious claim. Maybe the problem is there is a note surplus, right? That's the part that has to do with fraud, right? I mean, there is how much gold there is, right? There's not a shortage of it. There's simply too many claims on it. That's the problem, right? That is the fraudulent moment of banking, right? But this is what they say publicly. Oh, there's a gold shortage. We've got a problem, okay? Suspend the convertibility, okay? And then at this point, we have something that's never before been seen, right? We have money. It's paper money, but it's not convertible. It's non-convertible. What gives it its value? It's not the paper, right? I mean, because the paper could say 1 or it could say 20 on it, but it's not 20 times as much paper, right? I mean, it's the same size piece of paper. In any case, it's not worth 1 ounce of gold ever, right? I mean, well, that would be a pretty fancy piece of paper, right? No, it's not worth that, right? What gives its value is its convertibility. If you take that away, well, then what do you have, right? All right, so we'll get into that in the next lecture. All right, thank you very much.